The broadcast is now starting. All attendees are in listen-only mode.
Good morning. Thanks for joining our webinar this morning. This is Jim Guinan. I'm one of the annuity sales directors at Insurance Agency Marketing. We welcome you to our program today. We will be joined by Chad Weinhold from Allianz, Director of Sales. So in a little bit, I'll be turning over the presentation to Chad. By the way, Chad, can you see the screen this morning?
I can.
Good. Good. Well, I do want to remind you that our webinar is recorded. So if you want to listen to this later on or for some reason can't attend the whole webinar, we understand. And that's why we record our webinar. So they'd be available usually this afternoon. So with that, I want to get started, talk with you a little bit about things that are happening here at Insurance Agency Marketing. As we speak, we are continuing to offer several incentive programs for our producers. And one of those is our referred producer program, our marketing reimbursement, and on our next slide, we'll talk about the new producer bonus. So a little bit on the referred producer program. As you know, in your business, that the most qualified people that you can get in front of are referrals. So we welcome referrals. Individuals that are writing fixed annuity and life business, if you know those people and they're looking for a great home to place the business, tell us about them. We'll pay you $50 when they contract, and we'll give you incentives for them to continue to write ongoing. All you have to do is refer the person over to us. We will do the rest. We'll follow up and talk with them, and we will, and that is ongoing bonus and is unlimited. So you could refer a number of people to us. In fact, it's a way that you could build an agency without really working too hard at it, because we're glad to follow up and help those individuals. It makes our job a lot easier too. Our marketing reimbursement program, as you can see, gives you an example of indexed annuity conversion. So for every $100,000 of premium that you place, there would be $100 that gets put into your marketing reimbursement account. So this is an ongoing flow of dollars throwing into this account for you to use on your business expenses. So you turn in the receipts to our accounting department, and they will reimburse you 50% of those expenses. So that way we have money at stake for you, and that is ongoing. So you don't have to clear that out at the end of the year. You can continue to roll. If you know that you'll have maybe a seminar program or a couple lead drops that you want to do, you can tap into that and help us pay for part of your expenses. And the new producer program continues to be successful. Again, these are levels that you can obtain for writing business in your first 180 days with us. So once you've past 6 months on your contracting. So again, this starts when you contract. And so therefore you want to contract and hit the ground running with your business to maximize your threshold. So as you get to these levels, these are some items that you can look to be reimbursed for. And again, cash or gift cards are always very popular. But again, it's our way of saying thank you for placing your business with us here at Insurance Agency Marketing, and giving you dollars back as a way of saying thank you. You can use it for whatever you want. Okay, let's talk a little bit about our back office support. People that help me, that help you. Our case managers are not only helping you with the scrubbing of your new business that comes in, they also do the follow-ups, and if you have questions about the commissions of that, they help you from A to Z on the new business that comes in. And this is both for life and annuity. We do our best to scrub the annuity or life apps, get them off to the carrier, and then do the follow-ups that are needed so that we can kind of save you the time of having to call home office and get put on hold all the time. We also do assist you with life and annuity quotes. I'm in the annuity department. We do quite a few quotes ourselves. We also have several individuals that we can hand a quote to, and they get them out, I think, very quickly. So again, call us with your illustrations, call us with your case design needs. the paperless contracting that Chris helps you with, and those of you that are contracting know that that process saves a lot of time. You don't have to fill out contracting every time you want to get appointed with a new company. You would fill that out, and that contracting that we use, we call it a universal contract, for example, will have the ability for you to be appointed with over 90% of our carriers. So it does save time. Don't have to keep filling out things. Our marketing, our creative department, I should say, is an area that helps you develop your business even further. Now, some things that they do and are very busy with right now would be website design. So if you have a website and you want to see if it needs to be improved, talk with Jacob, talk with Sean in the department, and they will give you an assessment of what you could do. Also, kind of tying in your website with your brand. And if you don't have a brand, they can help you with that also. So again, anything that has to do with some of the items that you see on the page here, turnkey solutions, agency solutions, or digital solutions, talk with the creative department, and they will give you their guidance and let you know what cost may be involved with it. Our website is been updated recently. If you've not been there, our website is www.iamsinc.com. That's IAMSINC.com. It's a very good website, and I use it every day. I help agents with income rider needs, searches for products, and every day we receive calls from producers like yourself that are looking for a particular benefit or feature. It may be a nursing home enhancement. It might be a death benefit rider. It might be just finding a product for the person's age, because we do get more and more calls today about individuals in their upper 80s and early 90s, and they are looking for fixed annuity options. So we have a search tool that helps us with just finding the right product, and or if we needed to get you an income rider. Again, our annuity grid, what we carry at our desk, that has all the information about our top carriers and their best products, as well as income riders and the multi-year rate annuities, that is on the website too. You can find that. You can find our webinar schedule. You can find a term quote engine. There's a resource library with a multitude of information. If you need to check our website out if you haven't. It's there for you to use when, and hopefully when we're not here after 5:30 Central, there are the tools that you can use to get you through an appointment, perhaps that night. So again, use our website. If you can't find something, certainly you can talk with one of us. Okay, moving on to our IAMS Wealth Management. If you are interested in getting more information on the IAMS Wealth Management, please let us know if you'd like to get more information. If you'd like to, you can type in, yes, I'd like to get some information on IAMS Wealth Management, and we would be glad to get you out that information, or a phone call if you're curious about how this could impact your business and help you grow your business more. Talk with Charles and Mike and Joan, and they can tell you what's involved in getting a Series 65, what costs are involved, how that can help you in your practice. Again, talk with them about where you're at in your insurance business and how perhaps being an investment advisor rep could help you in the long run. Again, IAMS Wealth Management has been in business for over 2 years now. All right, our Life and Annuity Academy is a 2-day producer training. We do have one more academy scheduled for this year. It is in October. I don't have the dates yet, but we are accepting registrations still for this academy. And if you do send in a registration for this, we will call you. If you're not getting a phone call, please call us. I received registrations since our last academy, which was in May. And again, I contacted every person that sent that in and to my attention to let them know we don't have a date yet, but we are accepting. So It's a 2-day training, all expense. We're looking for those individuals that are active in the business, writing fixed annuity or life business. It is not a beginner training program. If you're new to annuities, you could participate in this, but I would say that we need to work with you for a while and see that you're going to be writing the business. So if you're active, that's who we're looking for, so that we can properly give you the advanced attention that this training provides. So again, if you are interested in that, there will be an email that goes out after the webinar is over. It will have a registration link, and there's also a sample agenda. Usually the program begins on a Wednesday evening, and it runs all day Thursday and half day Friday. So we do pack a lot of information in those short days. Our goal is to help you to give you more information to help you grow that business even further with insurance agency marketing. So again, if you have an interest in that, type in, that you'd like to get more information. Or if you have a question, you can reach out, talk to me or someone on our annuity or life team if you know somebody already. But please let us know if you have interest in that. This will be the last training for this year. Again, it's October of 2018. The next academy would be then next spring of 2019. Okay, and lastly, I want to tell you about our marketing summit. The marketing summit, the next one we have will be in 2019. It will be in late August. As you can see, this is an invitational period that goes from January of this year through June, so it's an 18-month period of time. It is both educational and a social event. And as you can see, those people that will be invited will be writing in the neighborhood of $3 million of annuity premium. So again, this is the Ritz-Carlton. It's in Naples, Florida. And if you're interested in how to qualify for that, it's pretty simple. Write a lot of business. But anyhow, we have standings for this now as far as where you're at. So if you're curious about where you stand, you've been writing with this, we do get an update about monthly on the progress of this. And we do look forward to seeing you there. Okay, so with that, I'd like to turn the presentation over to Chad at Allianz. Chad, I'm going to give the reins over to you. So hopefully you're able to take control here. Do you have the controls now? Chad?
Yes, I'm here. I apologize.
Okay.
I had it on mute. Does this show the financial capabilities in the United States 2016 on your screen?
I do see that, yes.
Wonderful, wonderful. Jim, I appreciate you having me on. Thank you, everybody that's on the call right now. I know that when you're not making phone calls, not meeting with clients, it takes away from business. We want to make sure that this is of value to you, that you can use. Potentially the next client that walks in your office is likely going to be impacted by what we're going to cover today in some capacity. The reason I bring this up, FINRA does this financial capability study on a regular basis. The last one that they did was 2 years ago, July of 2016. As you noted from the title of the presentation, too much interest rate risk. Most people go, well, what do you mean by that, too much interest rate risk? Well, the study, the financial capability study that FINRA did, focuses on a number of different aspects with regards to financial understanding within the U.S. They go out to the average American and they ask them questions about a range of financial topics, from how do you manage money, how do you make ends meet, how do you plan ahead. One of the big ones that has come up on a regular basis is this question right here. When they talk about financial knowledge, literacy, if interest rates rise, what will typically happen to bond prices? And what was rather telling is this second line right here. Only 28% of the respondents actually got correct what happens to bond prices. And if you talk to most of us in the financial services industry and you ask somebody, okay, what do you anticipate is going to happen with the interest rate environment over the next 3 to 5 years? We've been saying for the last 5 years, they're going to rise, they're going to rise, they're going to rise. And of course, in 2012, we saw the first of two dead cat bounces, if you will. Interest rates in the summer of 2012 hit what, 10-year Treasury was 1.6, 1.65, somewhere in there. And then they started climbing up, and everybody went, okay, we're past the low part. Interest rates start to rise, and we're actually going to see some relief. And then in 2016, we saw them retreat again. And we actually hit the new low where the 10-year Treasury hit 1.47%. So when you take a look at what happens with interest rate within a portfolio, we're going to walk through what are the implications, and then what are some of the things that we can do. How do we talk to our clients about this? Most clients, when you think about this, yesterday marked the official new high as far as the bull market. We are now in the longest ever bull market run in recorded history in the U.S. We've now beat the one from the 90s. We are now into the longest one. The question is, how long is this going to last? In early 2018, we saw what happens when volatility sneaks back in, and it wasn't necessarily expected, but we had 2 days in the span of, what, a week, where the Dow corrected more than 1,000 points. We've seen what happens when volatility sneaks in. People start to get a little bit panicked, and they get jittery, and they go, oh my goodness, okay, we hit the high, now we're on the low, where do we go? Well, they start moving into what are considered those safe assets, bonds, bond funds. So why are bond funds chosen for a retirement strategy? What's the impact that a rising rate could have? What is bond duration? And how do we talk about the annuities? You got to make sure I throw out the disclosure here. We're not here to provide legal or fiduciary advice. We just want to bring to the surface what are some of the issues at hand and why are our clients likely going to be impacted by this. Well, we know that bonds can provide a number of different options when it comes to a retirement portfolio. They provide diversification. They provide stability. Bond prices generally fluctuate less based on the emotion of the equities market. And we know that some bonds are federal and state tax exempt, but for the most part, bonds and bond funds are going to be taxed at an ordinary income rate, so very similar to that of annuities. I mentioned earlier, we've seen people changing from investing in the market to investing in bonds as a safer alternative. When things start to get a little bit loopy in the equities market, people retreat and they move to that position of safety. And there's an in and an out. But even those that have just a diversified portfolio, you're going to find very few people are all in when it comes to the equities market. You're going to find some sort of an offset, whether it's a shorter duration or longer duration bond. Most people, as part of whether you call it modern portfolio theory and you buy into that and you're using that as a way to be able to diversify a portfolio, or maybe you don't subscribe to the modern portfolio theory, but you're still keeping bonds for whatever reason as part of the portfolio. This is the teeter-totter that those of us in the industry have come to know and understand. As interest rates go up, bond prices go down. I'm not going to get into all of the details as far as the why. There's plenty of resources out there to be able to talk about this, but this is the part that clients generally don't understand. If interest rates go up, new bonds generally are going to be a better buy, but the bonds that I have that I'm holding in my portfolio are going to be at risk. Same type of thing when you look at decreasing interest rates, bond prices generally go up. So how does a rising interest rate really affect your portfolio or your client's portfolio? Well, think about this. We looked back about 65 years. We went back to 1953. And during the period from 53 to 1981, interest rates, generally speaking, rose over time. Now, you're going to see a couple of spots, in the late 60s, early 70s where interest rates came down. But as a whole, they climbed. And in that type of an environment, average return for the bonds was about 2.5%. It was your safe money. That was your great place to be able to put money and keep it safe because I was going to get a steady return. But when you take a look at the last 35 to 37 years, from 1981, in this case through 2016 and now through 2017, we've seen interest rates pretty regularly on a decrease, which is great because the average annual return for those bonds now jumps to more like equity type returns. We're talking about 10.5%, 11% on what my clients generally consider their safe money. If I can go out and I can get a double-digit return on my safe money, why do I necessarily have to take on additional risk in the equities market? Well, that's not necessarily what's happening as we go forward. When you take a look at some of the warnings out there, 2013, of course, coming off the bottom of 2012, FINRA actually issued an alert to investors. Watch out for bonds and the risk that may be associated. FINRA updated their alert. New York Times is reporting. Back when Janet Yellen was chair, it would be appropriate for the Fed to keep raising interest rates. Well, what's happened over the last couple of years? We've seen just that. And I'm going to show you a screen to actually highlight a couple of these time frames. But helping clients understand bond duration. If we look at a one-year bond, okay, one-year risk-free rate, a 1% rise in interest rate means that my client is going to see roughly a 1% decrease. 2% rise in interest rates, I'm going to get a decrease. But when you start looking at a longer term and you start going to a 10-year bond, a 1% interest rate rise means that I could be looking at a 10% drop in my bond value. And obviously that's amplified the more that those interest rates climb. So what happens as we go forward? We need to be able to offset this risk, and we know that annuities can be a solution in that regard. We know that they offer tax-deferred growth. We know that many of them offer a death benefit, and we know that many of them offer guaranteed stream of income if that's what they're looking for. What I wanted to be able to highlight in this case is if you take a look at the one-year Treasury rate over the last 2 years, the one-year Treasury rate has grown from roughly 50 basis points back in 2016 to almost 2.5%. That's a 4 to 5-fold increase just in the last 2 years in regards to the one-year Treasury rate. And if you take a look at the 10-year Treasury, here's what's happened over the last couple of years. Think about this. In August of 2016, before the election took place, again, we were coming off that bottom. 10-year Treasuries were running 1.6%. By the time we hit December 12th, they'd gone to 2.6. We saw a 100 basis point increase in just 3 months' time. And many of you recall this time frame right here was shortly after the election. Whether you believe it was the Trump bump or if it was something else, the reality is the markets responded. Well, then we saw them retreat, and we saw them drop back to about 2%. So September of 17, we're running right around 2%, and then we see it rise again. So within a 20-week span, now we're back up 80 basis points. So there's been a couple of times, even recently, where if you are managing those bonds for your client, you've seen the impact that this can have. When a client gets their bond statement and they start seeing a zero or negative numbers, it's not an easy conversation to be able to have. I thought this was supposed to be my safe money. Well, it is your safe money. Well, then why do I have a negative here? Why is it that after the management fee and whatever type of commission that I've paid or whatever type of management fee that I'm paying, I'm ending up flat or negative on a net number? For those of you that are managing these assets, you've had those conversations, or you likely have had those conversations. For those of you that are not managing, this is what those clients are experiencing. And now the question becomes, where else do I go? Is cash really the best option for me when it comes to how do I protect that conservative base in regards to my money? What I wanted to be able to share is a consumer piece, because we actually have one that actually talks specifically about this. It asks, does your portfolio have too much interest rate risk? And it walks through on an educational basis. Annuities are, of course, the overarching theme, but it talks about what are some of the challenges and what type of an interest rate environment do you anticipate. If you're one of those that believes that we're going to continue with flat or downward trending interest rate, like we saw from 1981 to 2016 and beyond, great. It's a great opportunity and a great time to be looking and investing in those types of assets. But if you're one of those that is seeing what's happening with the Fed in the short term, and you're seeing what's potentially happening on the long term, as I just showed with those charts, now there's some challenging, let's say, headwinds ahead with regards to those particular assets. How do we go about addressing that? And how do we make sure that if there is an interest rate increase, my portfolio isn't going to be adversely affected? One of the best ways to address this is to do just this. Let's talk about it with our clients. Help them understand. There's resources that we have available to be able to go out and share and say, here's what I want you to understand. Those safe assets, in large part, are still safe. But if we move forward and we see increasing interest rates, especially if we see like we did in 2016 and potentially during 2017, where you've got a quickly moving interest rate environment, this could have some negative impacts with regards to our portfolio and for your ability to save what you need when it comes to retirement. So how do we offset? Well, what if I could take away all of the downside risk? We could eliminate any of the interest rate risk, but still give you an opportunity to grow your assets. Allianz recently launched an accumulation product called the Accumulation Advantage. Clients have the ability to put their money into an insurance policy, an index annuity, that's designed specifically and exclusively for growth. No downside risk, so we've taken that interest rate risk off the table, but it does a lot of the same things. It provides a safe haven. It provides a liquidity option, so if I need to take money out, I can take out up to 5% of what I put into the contract per policy year. I've got the ability to grow the assets and reset that floor as far as where it grows, because in any year that the index is negative, I don't participate in that, but I do get the growth on the upside. And what we've done by adding the dual bonus benefit rider is we've now given a 10% bonus on the front end. So when clients put money in, think of their 401k. If I put money into a 401k, many companies will offer a match within some capacity, 3, 4, 5. Some of them will go as much as 7 to 10. We're going to give you a 10% premium bonus that's applicable to your walkaway value. Client puts in $100,000, immediately they've got $110,000 that's theirs to work with. And on top of that, we're going to give them an interest rate bonus. So that's the dual benefit, the dual bonus, if you will. Every year that they remain in that contract, we're going to increase their bonus percentage. So in year one, it's a 5% interest bonus. So it means if I get a 5% interest credit, I get 5.25 actually applied to my account, on top of the 10% bonus that we got coming out of the gates. The next year's a 10% bonus. The next year's 15 and 20 and 25 and 30 and so on down. So by the time we get to year 10, I've got a 50% interest bonus. For some of you that are familiar with our Allianz 222, we know that that applies to an income value. Has to be taken through a lifetime withdrawal benefit in order to be able to realize that 50% interest bonus. Not so with this one. This one allows your clients to get that 50% interest bonus on top of the 10% premium bonus that they got on their walkaway value. This gives them that opportunity to use this, whether it's for an inherited or beneficial IRA. It's a great way to be able to set some money aside for those conservative dollars and take that interest rate risk off the table completely, and still have that opportunity to be able to grow those conservative, safe dollars and put them to work within a client's portfolio. We've got this presentation available if it's something where you'd like to be able to sit down with your client. We've got the consumer piece here available to be able to help educate and walk your client through what are those potential risk factors in that safe money. But it's a great way for you to be able to have that conversation, and now you've got a specific target when it comes to the bucket of money that we're looking for. This isn't designed to be able to compete with the equities. Equities are for growth. Bonds are for safety. We want to be able to provide that safety net and give your clients a place that they can grow the assets safely and make sure that they're dealing with some of the risks that many of them don't even realize they have, and according to FINRA, don't understand it's part of their portfolio. If you have questions on any of the material, we'd love to be able to help you out. Jim and the group over at IAMS, they're very well versed in the products and resources available. So Jim, I'm going to turn it back over to you, close things out, and again say thank you to everybody that took time to listen in this morning.
Well, thank you, Chad. I appreciate that, and thanks for your presentation. I did want to mention to everyone also that if you would like to get more information on this product or any of Allianz's portfolio of annuities, let me know. Let us know here at IAMS, and we can certainly get some information over to you. Also, get you appointed with Allianz in the preferred line. So if you do have interest in that, you can certainly type in. I don't have the question available for you to respond to, but you can certainly let me know with a note, and we'd be glad to get you information and let you know what's involved in getting appointed. So I do want to thank Chad again. We appreciate your time. And if there's any questions, I don't have any questions right at the time, but often what happens, there will be some. So if there's any questions you have, please let us know here at IAMS. And I hope you all have a very nice, productive Thursday. Have a great day.